My name is David Blitzer. I was one of the panelists on the webinar concerning the housing recovery in the United States. And I'd like to take a few moments to answer a couple of questions that came up during the Q&A session, but which we didn't get to at the time. The first was looking at the overall recovery of U.S. housing from 2006 when it peaked to 2009 when it bottomed and then gradually came out. And while we spent a good deal of time discussing where we think it's going from here and how strong the recovery is, we didn't spend that much time talking on how we got to where we are. So I thought I'd say a few words. If you think back to 2008 and 2009, we had a great deal of disruption throughout the financial markets. One or two major firms, especially Lehman Brothers, filed for bankruptcy, and the economy dropped into a very, very deep recession from which it is still climbing out. But how did we get from the bottom of the recession to partway out where we are now, and what was housing's role in all that? The first thing that really stands out is the Federal Reserve. While there were a lot of government policies with a lot of different acronyms involved in the whole process, the Fed really stands out above and beyond everything else. And the Fed, either you can say poured money on the markets or printed huge quantities of money. Its balance sheet, how much money it's put out there, has ballooned in the process. But the Fed's efforts brought interest rate way down and really began to build confidence among people. First of all, it was very inexpensive to borrow money for just about anything. Second of all, it was clear that the Fed wanted to see the economy improve. It was not concerned about inflation. It was not concerned about too much growth. All it was concerned about was the absence of jobs, the absence of economic growth, and the collapse in the housing market. And that was really the beginning of confidence, as demonstrated by the fact that interest rates were and continue to be very low. Behind that came very slowly, much too slowly for most people, gradual improvement in jobs. The unemployment rate came down from 10% to about 7.6 currently. The consumer confidence began to pick up. We saw some improvement in retail sales. And slowly but surely, we saw first housing begin to stabilize. Prices stopped falling in 2009 and 2010. Home sales, which had plunged, began to creep back up in numbers. And then more rapidly, since about a year ago in 2012, everything began to come together and it built up. And the economy is really a case of the massive thing of everything tied together, and unfortunately it can pull everything down or it can push everything up. This was really a case of pushing everything up more than anything else. Behind all this was the recognition that one reason why people were so despondent and depressed during the recession is that we all lost a huge amount of money, whether it was money we had in the stock market or money we had in our houses in terms of the value of the house. A lot of that, unfortunately, disappeared. By pushing interest rates way down, the Fed set the stage to begin to have that come back. And the increase in wealth of most Americans is a key factor in what's sparked the housing recovery. The big question, clearly, which we discussed at some length in the webinar, is where it can go from here. And I think it's fair to say that across the four of us, we are moderately optimistic. We don't see any huge booms, but we do see some continuing improvements coming forward. The other questions got into more of the details in housing and so forth, and we talked at some length about existing homes versus new homes, different sales trends in existing homes versus sales trends in new homes. We also talked a little bit about multifamily housing, which people could call apartments, compared to single-family homes and what the difference was there. So it's probably worth adding a few words about that. First, for the S&P Case-Shiller home price indices, which I showed a number of charts of, these indices only cover existing single-family homes. They only cover existing homes because it's an index that's called a repeat sales index. What it does is it bases the calculation on the percentage change in the price of a house between the most recent sale and the previous sale. That's why it's called repeat sales. sales, you can't add a house to the index unless it has been sold twice. So it has to be an existing house. New homes haven't sold even once. So we only look at existing homes for the S&P Case-Shiller Home Price Index. And as I mentioned, there are different indices for condominiums, typically apartments, compared to single-family homes. The market for new homes and the market for existing homes are somewhat different, but they are related and clearly they're connected. If existing home prices were to rise rapidly, we'd see in any community where there was a choice between buying a new house in a new development and an existing house, people would move to the new houses just because the price differential would drive them to new homes. And this reverse could be true. If new homes are more expensive, the price differential would take people to the existing homes. That said, there are some other differences. Builders have somewhat different motivations than somebody just selling his house in terms of how fast they want to move the house, how anxious they are to sell it, their ability to provide financing or other assistance to close the sale. So there are some differences, but principally, I think the thing to remember is the markets are hooked together. The differences have to do to the differences we all deal with in housing. Where it's located, what it looks like, is it the right number of rooms, do I like the kitchen layout, all those details which are very important to buying a house. That's what sets existing homes apart from new homes. We also talked a little bit about multifamily housing compared to single-family homes. To mention one thing, in normal times, if you look over the last 25 years or so, look at housing starts or housing construction, probably 20% of that is multifamily homes. And the balance, 80%, is single-family homes. In the last 12 months or so, those numbers changed dramatically. Slightly more than a third was multifamily, 2/3 was single-family. I think that's going to readjust back toward the 20%, 80% kind of number gradually as time goes on. As home ownership has gone down, as was shown in the seminar, and as people coming out of a recession, a lot of them are a little bit nervous about making a big commitment about buying a house. Renting has clearly become a bit more popular, and renting very often means apartments. And that, plus the fact that a lot of large-scale builders building apartments probably have good access to capital, has given a temporary bump up to the multifamily share. But going forward, there may be some gradual shift. So while the multifamily share may not go all the way, will go down, it may not go all the way down to 20% overnight. These kind of shifts take time to take place. But looking at the big picture, I think the thing to remember is housing having come through an incredible boom, like one that hadn't been seen for 100 years, and then unfortunately an incredible bust that took some cities down to the point where home prices fell 50 to 60% from their peak. We're gradually working our way out. It looks a little bit better. It looks a good deal more optimistic. But in the long-run picture, houses in the United States on average probably only see their prices go up at the rate of inflation, or maybe the rate of inflation plus a touch more. The idea that your house is going to appreciate 50% in a year or two, unfortunately, that's not likely to happen again. Thank you very much.